Welcome to Close of Business. I'm Alicia Barry. A 4-day work week to lift economic output and living standards. That's the call from Australia's peak body for trade unions, the ACTU, ahead of next week's Economic Reform Roundtable. The Prime Minister's dismissed the idea of a 4-day work week, saying the government has no such plans. Economist and lecturer at Deakin University, Natalia Ilishina, thinks focusing on working hours is the wrong approach. She joined me. Natalia Ilishina, welcome to Close of Business.
Hi, Alicia.
Work less hours, keep the same pay is essentially what the ACTU is proposing. It sounds pretty great. What do you think?
It's an interesting proposition, but there is a research by Swinburne University recently released that based on the trials of 10 companies, it appears to improve productivity. However, there is no solid peer-reviewed research on that matter proving unequivocally and unambiguously that there are productivity gains. The idea behind it is that it's supposed to increase productivity through reduced burnout and increased staff retention. However, most research is based on the companies that are predominantly office work. There is nothing studied on the productivity, for example, in healthcare or on the construction side. So as an economist, I am not convinced that it has a scope to improve productivity at the moment.
The ACTU is also arguing that reducing working hours is key to lifting living standards. Is that the case?
An ACTU commissioner argues that working long hours is bad for well-being and productivity. Having said that, it's a very arbitrary statement that the current 40-day working week and five-day a week working hours is actually an overtime. What's considered overtime is beyond 40 hours. In addition to that, nothing stops an employee and employer to negotiate alternative working arrangements. We are given a lot of agency right now. An employee is given a lot of power at the moment by various enterprise agreements to get the flexibility, including for reduced hours and working from home. And the University of Swinburne study actually looked at the companies who voluntarily took up 4-day working week. So why not leave it to each industry and each particular company to see what best fits for them?
Is it true that even though employees might have bargaining power, they might not have a choice?
You are on point, Alicia. We are in a cost of living crisis and a productivity crisis, and the focus right now is on the economic growth, not on leisure, even though it might sound a bit sad for the public. We need to make sure that productivity and economic growth is lifted, because unless we produce more, the prices will not stop going up. And Reserve Bank governor earlier this week stated that there is no more Reserve Bank can do. It's now up to the government to lift productivity. That will be a matter for the next week's roundtable. And in terms of workforce, it's way more important to focus on upskilling and embedding AI. It's very hard to replace a person at the workplace with AI, but it's very easy to make a person more productive at the workplace. But again, at this stage, when we are in a productivity crisis, experimenting with a 4-day working week, no matter how exciting this proposition might be, is a very risky proposition, and it's not a good timing for that.
As you point out, this week the Reserve Bank's economic outlook downgraded the productivity forecasts. Do you think that it may be more important to be investing in human capital and skills rather than worrying about the number of hours worked?
Investing in upskilling, reskilling, and especially resilient workforce and education that is adaptable to technology is very important right now. So all those inefficiencies, which are actually very obvious and relatively easy to tackle, they should be removed first, and that will boost productivity and make workers produce more per hour. And after that, when we are on track and when economic growth is solid, there certainly will be a scope to revisit the 4-day working week.
Natalia Ilishina, thank you so much.
Thanks a lot, Alicia.
Another factor that impacts productivity is chronic illness. It can take workers out for days or months. Now researchers are counting the exact cost to business. They've found cancers and depression, along with sleep apnea and migraines, are some of the toughest challenges to deal with. National Work reporter Bronwyn Herbert has the story.
A breast cancer diagnosis at 27 changed Katie's world.
I had just met the love of my life. I'd quit my job and was ready to move to London in a couple of weeks. And then I felt a lump in my breast.
It affected her ability to work, taking months off to attend intensive treatment and then struggling to land a permanent job.
I talked to them about my circumstances of having stage 4 or metastatic breast cancer. And it was then, once we entered into those conversations about the flexibility or the concessions that would need to be made, it was crickets after that.
We have assessed different conditions.
Now, research from Monash University has put a price on the productivity burden of different diseases, including breast cancer.
In the first 5 years after the diagnosis, every year, women has lost almost half a year of their productivity.
The team has assessed different diseases based on their impact on productivity. Cancers and kidney disease top the list, followed by depression and other chronic conditions, including epilepsy, sleep apnea and migraines.
It was developed as a metric for decision making, especially looking at prevention strategies if we would intervene early.
Researchers say the economic burden isn't just about the loss in productivity at work, but also employees missing work or leaving the workforce entirely.
We are talking billions of dollars in productivity losses because of health conditions. Take migraine, that disproportionately affects women. $16 billion in productivity losses was the estimate.
Women's Health Service Jean Hales believes flexible conditions will help boost productivity.
Reasonable workplace provisions, maybe it's working on a non-symptomatic day, maybe it's starting later, would be a really great approach.
For Katie, not knowing her life expectancy, she just wants to stay connected.
Having to live in this limbo of continuing to work until I'm not able to just makes me more determined to want to give back and do that while I can.
One day at a time.
And staying with jobs, the unemployment rate has ticked down, once again proving the strength in the labour market. The data is in line with the Reserve Bank's forecasts, but markets scaled back bets for a September rate cut. Nearly 25,000 jobs were created in July, and a record number of women are in work or looking for a new position. Amelia Terzon reports.
After 7 years at LinkedIn, Natalie McDonald returned from mat leave this year and she got the call that many workers dread.
I was part of a big round of layoffs. I had a really great payout, but you do have that fear of what happens when the money runs out. I have 2 small children.
LinkedIn's parent company Microsoft has been shedding thousands of jobs globally as it invests in AI. Other firms here like Westpac, Telstra and Atlassian are also axing staff, but other industries like architecture are hiring.
I'm fairly optimistic about the growth of the practice over the next number of years.
That is showing up in official figures, with Australia's unemployment rate dropping slightly in July to 4.2%, thanks to 24,500 people finding work and around 10,000 leaving the jobless queue.
This month's labour force data shows that there is a record number of Australians in jobs.
Yes, the labour market's still tight, but the overall trend is for a little bit of slackening.
The Reserve Bank thinks the jobless rate won't get much worse this year, but if it does, economists say they'll likely drop interest rates further after already lowering the cash rate this week.
Natalie and her partner have a mortgage to pay. She's feeling hopeful about her prospects and is now launching her own consultancy firm.
It's really exciting. It's scary, but it's so wonderful.
She's hoping to help other working mums with their careers as a record number of women join the workforce.
The Reserve Bank has delivered more relief for borrowers, cutting interest rates by 1/4 percentage point. It's the third 25 basis point rate cut this year, and it couldn't come soon enough for millions of households. David Chow reports. The Reserve Bank has cut interest rates.
Well, that's good that the Reserve Bank went down by 0.25%.
An Quinn watches on as the RBA delivers relief for borrowers.
I'm hoping that with a rate cut, it makes it a little bit easier.
So please just look at my ear.
The Sydney optometrist works 7 days a week to run her business and pay off her home loan.
I would say cut out on maybe going to the theatre or the movies a little bit more. And only spend on essential things.
The 1/4 percentage point cut takes the cash rate down to 3.6%, its lowest level in more than 2 years. The RBA decision brought smiles all round.
We've made good progress on bringing inflation down over the past 18 months.
The Big Four banks were also quick to pass it on, as were many other lenders. Homeowners with a $750,000 mortgage who received the rate cut in full will see their repayments fall, on average, by $111 a month, bringing their total monthly savings to $340 since the RBA started cutting rates in February.
This is very welcome relief for millions of Australians. It will put more money in the pockets of people who are under pressure.
Last month, only 3 members of the RBA board voted in favour of a cut. This time, the decision was unanimous. However, Michelle Bullock has warned that because the RBA didn't lift rates as high as other countries, there might not be room to cut rates much further.
In the forecasts, we have inflation coming back down to target and the unemployment rate remaining where it is, with a couple of more cash rate cuts in there.
Also in the RBA's forecasts were downgrades to average earnings, household consumption and economic growth. Why? The central bank now thinks productivity will grow slower than it previously expected, something it can't do anything about.
We're overestimating the ability of the economy to grow. We downgrade that, we downgrade growth, but it doesn't have implications for employment and inflation.
I'm going to be a bit annoying and ask about productivity.
As questions about the P word kept coming.
Long-term productivity, the productivity summit,
productivity, flatlining productivity, weaker productivity growth.
The RBA governor was keen to remind journalists why they were there.
The news here isn't productivity. The news here is that this is our third decrease in interest rates.
From here, economists think the RBA will take a gradual approach.
Our central case is the RBA may deliver another 2 more cuts in this easing phase. We think that might come at the end of this year and then early next year as well.
At least 1, maybe 2, could even be 3 more 25 basis point cuts before they're done.
Back at the optometrist, future rate cuts can't come soon enough for An Quinn and her customers.
I find that everyone's spending is a little bit more cautious, even including myself.
With rate relief, a bit of respite.
I think I'll definitely treat myself to a mini holiday and maybe like a pampering session, a massage session or so.
Eyeing a better work-life balance in the future.
Some mortgage relief may be on the way, but getting a foot in the door of the housing market is tough. 2 of the nation's leading economists are calling for a tax on wealth, land or the family home. Their research reveals inequality in Australia is much worse than statistics suggest. Rihanna Whitton reports.
2 25-year-olds, both hardworking but facing 2 potentially very different financial futures. One is a homeowner.
I was fortunate enough to have a family who was willing to let me stay at home essentially until I saved up a deposit. The second thing is that at the time I was able to take advantage of the government scheme.
The other, a renter.
I've tried to make smart decisions. I went and got a degree. I got a job in a niche field within my degree, one that pays well, and I'm still unsure whether or not I'll be able to save enough to get a home in a reasonable time frame or at all.
New research reveals the stark inequality between those who don't own their homes and those that do. and our favourable tax system is to blame.
The amount of privilege that homeowners are given in the tax and transfer system is really quite extraordinary.
For the first time, economists have measured not just people's wages and welfare payments when looking at income inequality, but also the untaxed income they get from their homes.
There's two ways you get effective income from your own home. The first is you effectively pay yourself rent. The second component is the capital gain, particularly in Australia, where we've had quite substantial capital gains on property, certainly over the last 30 years.
The research from UTS and Melbourne University found that while the average disposable income of outright homeowners is 34% higher than renters, when housing is counted, that income gap widens to 86%. Including that, Australia rises to become the 10th most unequal country in the OECD.
Owner-occupied housing is in a sense like the elephant in the room.
Our tax and transfer system looks a lot less progressive than if you are only looking at cash incomes.
The economists argue exempting the family home from the capital gains tax costs the budget $50 billion a year, discourages more productive forms of investment, pushes up home values and locks young people out of the property market. To make the system fairer, they're calling for a tax on land, wealth or the family home.
My judgment is that probably none of the options that we canvass in our article are politically palatable.
There are obviously areas that no sensible government would go near, and that's one of them.
Indeed, it's an idea this young homeowner doesn't support.
I already kind of pay an owner-occupier tax in the form of rates. To have rates and a tax, it just kind of feels redundant.
This renter agrees. He says instead investors should pay more.
I don't know many people my age who own homes, but I can think of a lot of people who are maybe double my age or so that own multiple homes and they don't need them.
The report's authors think there might be a way to win those young Australians over.
You may get a different response if they could see and be confident that income tax cuts would be accompanying the introduction of taxes on housing wealth in some form.
A simple but far from easy fix to boost home ownership.
The Australian share market keeps pushing higher, hitting another record. The ASX 200 and the All Ords ending the week up by around 1.5% each, both at new highs. Julia Lee is the head of client coverage at FTSE Russell. She joined me at the end of the trading week. Julia, the share market just keeps pushing higher, touching another record this week. What is behind the gains?
It was a great week for Australian investors. We saw the Aussie share market hitting above 8,900 points. Now, there are a number of drivers for the market at the moment. First of all, we saw the miners having an amazing week. The materials sector was up by 3%, and that's being driven by a stabilised outlook for China, which is really lifting sentiment all throughout the region, but especially for the miners. Secondly, we saw the Reserve Bank cutting interest rates this week and leaving the door open for more interest rate cuts. So those highly geared, highly leveraged sectors like the utilities as well as the property sectors doing well this week. And finally, earnings season. We're really starting to see some resilient earnings coming through, and that's great news given the stretched valuations we are seeing on the market.
So banks were very much in focus with our biggest bank, CBA, reporting this week. Any key trends coming out of those earnings reports?
We saw a full-year report from CBA, but we also saw reports coming through from Westpac as well as ANZ. And this was a key one because we know that bank valuations have been extremely stretched. So if we have a look at some of the trends that came out of the reports this week, first of all, on the positive side, we are seeing lending as well as deposits growing, which is great to see. Delinquencies amenities is also something we're watching given the cost of living pressures, and the good news is that they still remained pretty low. Where we did see the jump was the jump in expenses. So digital transformation, investing in artificial intelligence, that saw a jump in terms of the expense side of the equation, and that will probably mean some restructuring ahead as well. It was also interesting watching the share price performance. Commonwealth Bank down by 5.6% for the week, but that was good news for some of its peers. We saw ANZ up by 6% and Westpac gaining a huge 8% for the week.
And of course, CBA is coming off a very high base.
Absolutely. I mean, CBA has had an amazing run, so it's not surprising that we are seeing some of the investors profit taking, given the very strong run it has had against its peers.
So we've talked about the banks. Where do you see the winners and losers outside of the banks this earnings season, or even including them?
Well, this week, I think on the losing side, it has to have been AGL. AGL in the utilities space down by about 12.5%. Now, we've seen a couple of the power stations with outages, and that's impacted, but also some of those older contracts where it is getting the cheaper coal as well as gas, they're starting to expire. So those contracts are being replaced by more expensive contracts. On the plus side, brokers do like its exposure to the storage battery area, but that was one of the losers this week. We did see some pretty big moves as well. I think the lithium miners are worth a mention. This wasn't to do with earnings season as much as it was about a large Chinese miner, CATL, which saw one of its major mines halting output. So hopes that we're seeing stabilisation in terms of the oversupply there. Pilbara Minerals as well as Minerals Resources up around about 6%. And Star up by 20%. A lifeline there. It's managed to offload Queen's Wharf, so we saw a big jump in its share price off a very low base.
Now, earnings season continues well into next week. What is there to look out for?
Well, for the property investors, we will see a raft of reports coming through from the property space. So Goodman Group, Stockland, just to name a few. But in the property space, what we are watching is the sensitivity to falling interest rates, which tends to be good news for property stocks. And we're also watching revaluations, which tends to be a big driver of share price action. Also watching two of the biggest companies on the Australian market, BHP and CSL, will report earnings. BHP expecting to see earnings per share dropping by 20% given those weak iron ore prices in the financial year. But CSL, steady as she goes, expecting to see growth of 8% there.
Julia Lee, thanks so much.
Thanks, Alicia.
We may be nearing the end of winter, but Australian ski fields are getting a fresh dump of interest. The snow businesses are putting 2 poor seasons behind them and overcoming climate change and competition from overseas slopes. Local ski resorts are making big investments, a sign of a bright future ahead. Daniel Ziffer reports.
Everything's turning to white. For long-time mountain goers like Andrew King, the strong start to the ski season is a joy.
It's been fantastic. School holidays have been great. We've had a mix of, snow coming in, sunny weather, certainly lots of smiles, lots of happy people down here.
It's also a relief after tough years and pressure on operators. With more competition from overseas, Australian resorts are investing big. Parrish's parent company, the US-based Vail Resorts, just spent more than $25 million on this 6-seater chairlift, which can take 3,000 people an hour to the highest lifted point in Australia.
We're going to get a minimum of probably 20 years out of that chair, and that's the appetite to invest in things that are going to make sure we have that sustainability as a business. And there's a lot riding on it. It's not just us, it's the local community, it's all the people that want to come and enjoy the snow.
It's not particularly easy to ski in Australia. Apart from 2 spots in Tasmania, all of the resorts are between our 2 largest capitals, Sydney and Melbourne, and the season is measured in months. But most years, more people will attend resorts like this than go to the Great Barrier Reef in a single year.
Typically, there are almost 2.5 million days spent annually at ski resorts. But the restrictions of COVID and then 2 poor seasons trimmed that. It's expected this year there'll be more than 2.5 million visitor days again.
It's been an incredibly strong season so far, from the June long weekend right through the July school holidays. The way that we're tracking, we should be consistent, if not in excess, of that pre-pandemic visitation level.
Despite climate change lowering the amount of natural snowfall, improved snowmaking means resorts are actually open for more days per year than in decades past. providing another reason why companies are making big bets on the future.
If you look at New South Wales alone, it's in excess of $80 million of investment in the last 5 years.
Built in 1910, Mount Buffalo Chalet closed its doors 20 years ago. Now, it's waking up.
This is a building that needs people in it.
Sports centre operator Belgravia Leisure has taken a 40-year lease on the chalet and will spend $10 million to refurbish it, starting with a cafe before moving on to fix up more than 100 rooms.
We're absolutely full in to delivering, getting this place open and getting it full. So yes, it's a long lease, and yes, there's a commitment to that, but we're confident.
When it's completed, around 300 school children and staff will visit here all year round.
It is a real commitment on behalf of the industry to the long-term resilience and future that we see.
With tourists come benefits to the local community.
The more people that come, obviously, the more they spend in our businesses. So that keeps everything going. The visitor economy is crucial here.
Businesswoman Karen Jarvis isn't in the snow game. She runs a business that supports tradies with their administration. But she sees how areas like Jindabyne rise and fall.
There's a lot of people say, oh, there won't be any snow left because of climate change, but then they install a chairlift like that and spend that sort of money. They've got the confidence that they're going to be using that chair for a long time.
These are big bets. Millions of dollars spent on assets that are only good at one thing in an area far from population centres for a season that only lasts a few months a year. That's why it's a lot easier to visit a ski resort than it is to own one.
Seemingly for decades to come.
This week, Alan Joyce landed on the speaking circuit, using his first address since leaving Qantas to defend his decision to sack 1,800 staff during the pandemic. At an aviation summit, the former airline CEO said his decision saved the carrier.
Qantas was the only major Australian airline not to go bankrupt during or after the pandemic. And that wasn't luck, that was resilience.
The airline will be in court on Monday to learn how much it will be fined for the sackings. And that's all from Close of Business. For more on those stories, you can go to our website and catch The Business Monday to Thursday evenings at 8:45 Eastern on the ABC News channel and after the late news on ABC TV. I'm Alicia Barry. Thanks for watching.